Welcome to our August Reg Brief. Before we untangle the increasing amount of regulatory activity that took place in July, I just want to shout out to Spain for winning the World Cup. I have to say, living in Massachusetts while the World Cup was going on was definitely a highlight of my summer. I am Stephanie Lyons, Senior Vice President of Regulatory and Risk Intelligence at Ncontracts, and I am joined today by our talented Director of Regulatory Intelligence, Robert Brosh, and financial industry practitioner, as well as our regulatory intelligence expert, Tony Fennell. We'll start with industry-wide developments, then zero in on depository institution updates. Up first, we have the passage of a major law package that has a lot of individual banking related bills. Robert is going to do the job of breaking that down for us.
That is right. It is definitely one of the biggest pieces of legislation that impacts financial institutions in a lot of different ways that we have seen in a few years. It is the 21st Century Road to Housing Act, and it's HR 6644. This law does contain a variety of different provisions. We have applicability to banks, credit unions, and lenders. And just to make sure that I am conveying the information in a way that allows you to know which provisions are applicable to your institution type, I am actually going to end up splitting this one up a little bit throughout the rest of the reg brief. But I will go ahead and start with the provisions affecting lenders. I do want to touch on these a little bit of a higher level than generally what we do, and that is because Ncontracts actually has a mortgage industry update webinar scheduled for August 20th, where we will go into a lot more detail. That'll be myself and our lending expert, Alicia Briley there. So definitely go to Ncontracts website and register if you are free that day. So this law for lenders does primarily impact those involved with government programs. We're talking VA, FHA, and USDA guarantees, as well as lenders who do sell their loans to Freddie or Fannie on the secondary market. So first up, for FHA loans, any borrower that is 30 or more days delinquent has to be given an opportunity to participate in housing counseling, right? That may already be part of your institution's loss mitigation or modification processes, but this is going to be a strict requirement now. Second, USDA, VA, FHA, and FHFA. They have to establish a formal review and resolution procedure set for borrower-initiated reconsiderations of value. So that way you can follow up on appraisal requests where a borrower doesn't necessarily think that the appraisal came back valued at the right amount. And so that means we will likely see rules in the future from these agencies requiring an ROV process for those federally backed mortgage loans, right? And you probably already have an ROV process now because those procedures are currently permitted, but they aren't necessarily mandated by law. So I think that we will see a much stricter regime around ROVs. Last big one for lenders to know is that the FHFA has to change the Uniform Residential Loan Application Disclosure for military borrowers. So right below that military service question where you're asking if the applicant is a military member or not, it does have to state that the military member may qualify for a VA loan. And then additionally, if there is a military member who is applying for an FHA loan, right? Loan docs for FHA mortgages now have to show a side-by-side comparison for VA guaranteed loan costs against FHA loan costs. So definitely a lot of changes coming down, not only going to impact your internal operations and processes, but also third-party systems with your loan origination system or your document provider. So again, join us in August for Ncontracts webinar, where we will go through all of those and more in more detail.
Thank you, Robert. Let's talk about the CFPB next. There are quite a few of updates from the leadership, and we have things like changes to who's going to be running the agency, to new rulemaking and new guidance. So we're going to start at the top here with the fact that the Bureau has been without a confirmed director for roughly 18 months. And that is probably going to change very soon, especially now that the ability of current acting director Russell Vought to continue to lead the agency has lapsed. He is no longer allowed to continue being in that position as of August 1st. So we're all waiting to see who's going to lead the Bureau long term. And a nominee has emerged and was just recently grilled by the Senate Banking Committee, and his name is Brian Johnson. Mr. Johnson is not new to the CFPB. He was actually a deputy director during the Trump 1.0 administration, and today he is serving as an executive at Capital One. Just remember, interestingly enough, Capital One did catch a major break earlier in 2025 when Vought dropped an enforcement action against it that was later picked up by New York. But anyways, the question now is whether Johnson will lead the Bureau any differently from his predecessors. During the hearing, he already named three priorities. Number one, protecting consumers from fraud and scams. Number two, keeping the Bureau inside its statutory lanes. And number three, modernizing operations. So not at all very different from what we have heard already from prior leadership. And Johnson did say he is not intending in eliminating the agency. So that is a little bit different from the tune we had in the past. We will definitely be validating that statement a lot more when he takes over the CFPB's litigation regarding its reduction in workforce that has been stopped until the new director takes over. Johnson is likely to be confirmed in the next couple of weeks to months, depending on whether the Senate comes back from recess and when they do all of this, but he will be joining quite a dynamic environment, let's call it. In any case, even without a confirmed director, the Bureau has been increasingly active. Just recently, the Bureau published its semi-annual regulatory agenda with a lot of to-dos. There is regulatory action coming for mortgage servicing, ability to repay rules, and so much more. However, I expect a lot of changes potentially to this agenda and its timing based on the fact that Mr. Johnson will be confirmed soon. Since we do have a lending webinar like Robert mentioned, I'm going to leave those lending related updates to them to break down, and I will jump to section 1033. Quick recap for anyone who's been gleefully tuned out of this saga. The CFPB finalized its open banking rule back in 2024. Financial institutions, of course, sued, and a federal court blocked enforcement of this rule. CFPB's own lawyers at the time asked the court to kill the rule, but then they reversed course and said, never mind, we actually want to take a stab at rewriting it instead. What's being reconsidered right now is whether financial institutions can charge fees for data access. The original rule said no. And who counts as an authorized representative that is going to be allowed to pull a consumer's data on their behalf. A proposed rule addressing all of this is expected right around the corner, probably this summer. Another interesting one is the return of late fees. Let's go back to 2024 again when the CFPB cut the credit card late fee safe harbor from $30 or $41 for repeat violations down to just $8. The industry, of course, sued and the rule got thrown out by the court. Now, the Bureau is signaling a request for information on late fees and late payments. We don't have information on what the CFPB's direction will be, and I don't believe that this is going to be the revival of that $8 rule or that cap, but it does point to the fact that late fees have not left the Bureau's radars or the conversation across state attorney generals. To summarize, I hope you enjoyed the free time we've had this summer because in Q3 and Q4, you're going to need to reserve some significant bandwidth to deal with mortgage servicing rules, ATR, qualified mortgage, 1033, and so forth. The second any of these changes land, you will be informed via Ncomply, so make sure you tune in. Let's move on to our final update regarding the Bureau, and it is also tied to the CFPB, but I'm also going to bring in the other banking regulators. In a prior reg brief, we flagged the executive order on restoring integrity to America's financial system, and we highlighted the requirement for federal regulators to issue credit risk guidance on lending to borrowers who are not legally authorized to work in the US. Well, that guidance dropped, right? First, we had the CFPB that issued a statement telling creditors that Truth in Lending and Reg Z may require weighing a borrower's immigration status when assessing repayment, specifically because removal from the US could cut off a borrower's income, which is a credit risk. This is a very sharp turn from prior statements by other administrations, so something to be on the lookout for. Then, most currently, the OCC, FDIC, and NCUA jointly told banks and credit unions to apply existing safe and soundness underwriting practices to this population, treating uncertain income, employment continuity, and financial stability as credit risk factors. One additional consideration that I want to flag for you is portfolio concentration risk. If your book has concentration in industries, geographies, or employers that could be disproportionately impacted by immigration enforcement, the agencies want you evaluating that risk the same way you would evaluate concentration risk in agriculture or the energy sector or technology that tend to have those dips and some profitable years as well. Here's the issue with both pieces of guidance, right? Neither the CFPB or the banking regulators tell us how to do this analysis. On top of that, the agencies did not really draw a clear line between a legitimate credit judgment and potential disparate impact that could arise regarding national origin under both the federal or state laws that we have in play today. That gap right there is the gray area in compliance risk that could take us into a troubling area. So before modifying your underwriting policy language, you may want to engage with your fair lending counsel, do risk assessments, and make sure you understand your risk tolerance and your exposure. With that, let's move on to issues affecting depository institutions. And you're going to notice that the theme here is AML all day. Tony, who is also CAMS certified, will lead that discussion.
All right. So first up on the AML side, and this is a good one, a federal forfeiture case involving roughly $79 million tied to an unlicensed money transmittal operation. This outfit moved hundreds of millions of dollars for a foreign bank and a stablecoin issuer's customers, and it separately laundered proceeds from a government impersonation fraud scheme, converting victim deposits into cryptocurrency and shipping it overseas. But here's the part I actually want to spend time on. This company told several large national banks it was an IT company, sidestepping the extra scrutiny its real business type should have triggered. And that story should never have made it past the first few months of account activity. Think about what an IT company's banking actually looks like. A handful of larger reoccurring payments, invoicing patterns, pretty boring stuff. What actually showed up in these accounts was hundreds of millions of dollars cycling back and forth between a checking account and a security account, mostly on behalf of foreign counterparties. Layer on top of that, a second pattern, individual victim deposits from the fraud scheme, converted into crypto and moved out within days every single time. Neither of those patterns looks anything like an IT services business, and both of them are exactly what ongoing monitoring is designed to catch. This is a know your customer story and a monitoring story, full stop. The account's actual behavior stopped matching its stated purpose almost immediately, which is exactly the signal a periodic activity triggered review is designed to flag. One institution caught the red flags and closed the account citing AML concerns, We don't know if that closure ever became a referral to the other banks holding the same relationship, but the money kept moving through at least one of them uninterrupted, in fact. That's where the bulk of the activity ran through afterward. So if there's one line to pull out of this one, it's this. A stated business purpose is only as good as your ability to catch it drifting from what the account is actually doing. Onboarding gets them in the door. Ongoing monitoring is what tells the story if that holds up. All right, so we have another case. So moving to that second AML item, and this might be the headline enforcement case of the year because it's a governance failure a lot more than it's a technical one. The bank agreed to pay over $9 million in forfeiture under a non-prosecution agreement with the Department of Justice, admitting to willful failures in AML program spanning more than a decade. Prosecutors say the bank knowingly let favored clients run a check kiting scheme and, get this, the compliance top tried to stop it more than once. The scheme itself was run by a father and son, and it ended up costing another institution around $6 million. Now, here's what actually turns this into a governance story instead of just another AML myth. The father in this scheme was a friend and business partner of the bank's own former chairman and CEO, who resigned back in 2019. Compliance tried more than once to close these accounts down. Senior executives overrode them repeatedly. And this isn't some isolated blind spot for this bank either. They separately settled with the SEC and Federal Reserve back in 2022 over deficient internal controls tied to insider lending for roughly that same stretch of years. So this wasn't a program with no controls in place. It was a program where the controls actually worked. They flagged the issue more than once, and it still got overridden anyway. We made this exact point in our own enforcement action roundup when this case first came out. A program can be rendered completely useless the moment leadership decides it's willing to override it. The fix for that isn't a better policy. It's real escalation authority that survives that kind of interference, and an audit committee that's actually paying attention. One more wrinkle before we move on, the statement of facts also describes the bank backdating loan payments for about 2 years, specifically to this relationship as well, keeping it off its delinquency reporting in the call reports. That's a separate integrity problem stacked right on top of their AML failure. Bottom line on this one is a control that leadership can override without a consequence isn't really a control. The real test isn't whether you have an escalation policy on paper, it's whether that policy works when someone senior wants to look the other way. Okay, so let's move on to issues affecting banks, and this is our last AML item today. This one is shifting gears from enforcement to rulemaking. The Federal Reserve has now put out its own proposal for AML CFT program requirements. This is the one that follows the joint proposal FinCEN, the OCC, the FDIC, and the NCUA put back out together in April. I'm not going to walk through the mechanics of the rule itself. What I want to flag is where the Fed's version splits off from that April proposal, because that's the more interesting story. First, the Fed didn't even join the April proposal, and this isn't the first time it set out of a joint rule like this. It also set out of a FDIC OCC proposal last fall. Second, and this is the point we're sitting with, the Fed's proposal is nearly identical to the April proposal, same structure, same general approach, but it references and then leaves out one provision from that original proposal that was controversial, a requirement that the agencies run any significant supervisory or enforcement action by FinCEN 30 days before taking it. The Fed's rule brings it up, and then it doesn't include it. Instead of just quietly dropping it, the Fed invited comment on whether that 30-day FinCEN check-in should go into the rule, and It did the same thing on a related piece, asking for comment to weigh in on whether banks should have to share details about any existing or potential enforcement action with FinCEN. So neither of those FinCEN facing provisions is settled. They both are live questions, and the Fed's putting it out for the comment process rather than answering itself. On top of that, at least one Fed governor has publicly raised concerns about the proposed standard. So this might be an actual disagreement over FinCEN's role, not just a scheduling quirk. Comment period closes on this September 8th, so it's worth weighing in if you have a view. Regardless of how the comment period plays out, this one's worth watching, not because the rule itself is dramatic, but because the split is visible between the Fed and the other agencies, which doesn't happen often.
And it definitely complicates the landscape for sure. Now that we're done with anti-money laundering, let's stay with bank topics, continuing the discussion on the Road to Housing Act law. Robert, take it away.
That's right. So for the provisions for banks, there are a handful. I want to touch on a couple here, and the main one is the shift in exam cycles. So prior to this law, the 18-month exam cycle only applied to institutions under 3 billion in assets that are well capitalized and well managed. However, this law has bumped up that threshold to 6 billion in assets now, meaning that many more community banks are going to see a bit of supervisory relief when it comes to exam frequency, right? That shift from 12 months to 18 months now. The one thing I'll say there is don't let those extra 6 months allow your institution's compliance management system, your enterprise risk management program slip, as it could mean more trouble down the road. Then another major change here is to brokered deposits. So custodial deposits, which fall under brokered deposits, can now be taken in up to 20% of liabilities without being classified as brokered deposits, as long as your bank is well capitalized, under 10 billion in assets, and has a CAMELS rating of 1, 2, or 3. It also restructures the reciprocal deposit exemption, so another type of brokered deposit, into a tiered formula, scaling from 50% down to 30% as liabilities grow toward a 96.3 billion cap there. So that means more reciprocal deposits do not need to be treated as brokered, opening up more opportunities for banks to obtain funds. So for banks, right, that is a big one. There are a few others along the lines of public welfare investments and raising the cap there. So what banks need to know is definitely to notify your CFO or accounting or your controller, whoever it is, to be aware of these changes, especially when it comes to broker deposits, as it can open up opportunities for growth within your institution. I am going to stick with examinations though, because the Fed, FDIC, and OCC, they did decide to team up on this one. They did put out a statement to provide guidance on how examiners and banks should deal with highly sensitive information come exam time. And while there isn't necessarily a specific, explicit named reason for this statement and for this guidance, my mind initially went back to 2023, where the OCC had a major email data breach that involved over 150,000 messages. It included exposure of sensitive financial institution information and customer information. So definitely a big problem. I think there was another one with the CFPB back in the day. So a little less of a framework for the agencies themselves to ensure that there is protection. So the agencies have committed to notifying affected banks now within 72 hours of confirming that there has been a material compromise of confidential supervisory information. The agencies are giving themselves a little bit more leeway than banks themselves have to report cyber incidents, right? The agencies have 72, banks have 36, but that's not really too much of a surprise there. But for banks themselves, the agencies are placing a requirement on bank management to flag which documents and data that the regulators request that management considers highly sensitive. So think of things like your network diagrams, penetration test results. Maybe you have documentation on specific IT control weaknesses and succession planning. Those things that carry heightened risk, if exposed, could pose a high degree of results and issues for your institution. So examiners are going to notify banks at the start of an exam that banks are able to raise concerns about information requested. Banks should raise them directly with their examiners or their primary agency contact. And then from there, the plan is for examiners and the bank to work out together which material actually qualifies. And once that data is agreed to, the information is going to be handled differently than your general examination requests. It could include things like on-site reviews rather than taking copies. It could include direct digital review from the systems of your bank. We could deal with redaction or summarized versions of documents. Basically, any method to limit how much sensitive material actually leaves your bank or gets stored by the agency. And so, if after using one of those methods, examiners still determine that they need the material for supervisory record, then the agencies now have a sign-off process and method through their supervisory chain in order to obtain that information. So I think two things are worth flagging here for your compliance and IT teams, right? This creates an avenue to negotiate how sensitive technical exam requests get fulfilled. There's going to need to be collaboration and working with your examiners and with the agencies to a higher degree than it is today. And then there is also a defined escalation path if your bank does disagree with an examiner's call on what counts as highly sensitive. So you're not kind of stuck in this situation where they say one thing, you say another, and there's no route to resolve that. One caveat, and the agencies love to mention when things aren't necessarily legal obligations. They are that this guidance is a best practice, not a binding rule. But as we all know, when it comes to guidance from the agencies, it is very often in your best interest to follow that guidance. It can definitely save you some trouble down the road.
Some trouble, but it also sounds like a double-edged sword. Anyways, moving on to credit unions. Last month, the industry was exposed to a major cyber event via a third-party vendor. I'm talking about the True Stage event. The insurance provider for the vast majority of credit unions out there, they shut their network down after spotting unusual activity. Their CEO stated that the likely cause was a human firewall failure. Basically, an employee downloaded what they thought was a legitimate software tool, and instead they got a malicious file. TrueStage says it's a little too early to know what, if any, data was exposed. And as of the date of our recording, we know that the company is still working on restoring access to their products, services, and systems, which means some credit unions and their members are still locked out of retirement accounts, gap insurance claims, and payment protection products. We have also heard from other credit unions that they can't complete the bond check that they need to onboard new tellers and branch staff. And they are also having to hold 401k employee contributions. So all around a pretty problematic issue. One thing to check on right now is the regulatory requirement to provide a cyber incident notification to your regulators. Remember, NCUA, they have a 72-hour rule, which runs on what you know and doesn't really pause for true stages, investigation, or disclosure timeline. So if you have a relationship with that vendor, your reporting obligation may already have run out. Make sure you filed, or at a minimum, you analyze your responsibility to do so. Something else that's coming out of this potential breach is a lawsuit. A credit union in Pennsylvania filed a nationwide class action against TrueStage, arguing that the security this vendor marketed to its credit union partners was really not matching the security they actually had in place. Prior vendor breaches have taught us that FIs can't really dodge liability when the issue was caused by a third party. But this lawsuit is going to answer whether a credit union can make that vendor eat the cost when their own security promises don't hold up. Outside litigators that are watching the case say a claim like this starts with the contract, and that's where we recommend you should start your preparations as well. You're going to want to pull your vendor contract, confirm exactly what triggers your vendor's notification to you are, and on what timeline. Some agreements are pretty broad and they allow vendor notification as soon as reasonably practical, which gives them a lot of leeway to actually provide that information as opposed to having a specific number of hours or days in which they're responsible to notify you. The second thing is to check whether your incident response plan accounts for a vendor going dark. Not just a breach that starts inside of your own network or your own institution, because a lot of plans we have reviewed only cover that second scenario. Third, document everything as you go. Every member call about a delayed claim, any locked out account, they all belong in an incident file for this breach or this event. Second, fourth, make sure you're revisiting how often you verify a vendor's security claims. If you're only asking information every 2 years, every 4 years through questionnaires, those answers are likely to have meaningful changes, especially with how quick technology is moving and advancing. We don't expect vendor breach issues to quiet down this summer or for the remaining of the year. We actually did a third-party risk survey earlier this year, and we found out that 52% of institutions have already reported a third-party cyber incident in the past 12 months. So make sure your business continuity management program accounts for vendors and that you are resilient to these issues. We did publish a blog on this cyber event that is worth checking out. And I also want to give a plug to my colleagues, Michael Carpenter and Michael Berman, for the amazing new book they just published on this topic called The Upside of Third-Party Risk Management. It is such a timely topic. It's something worth reading by the pool this summer, so make sure you go for it. And I'm going to hand it over back to you, Robert, to close us out with the last update for credit unions.
That is right. Now we are talking about the Road to Housing Act again, and we will finish with our credit unions. So we do have movement on board frequency requirements. We are moving board meeting frequency requirements. We are moving from a blanket monthly requirement to now a tiered schedule based on your institution. So de novo credit unions still have to meet monthly for 5 years, but well-rated credit unions with a 1 or 2 composite and management score, right? So it needs to be both your composite score and management at 1 or 2. They can now drop to 6 meetings a year, with at least one of those meetings needed to be within each quarter. So lower rated credit unions, you do stay on the monthly track. But similar to what I said earlier, don't let the decrease in required meetings result in worse issues down the road for your financial institution. You may have a board that still does want to meet monthly, and if that is the case, that is fantastic. They want to know exactly what's going on, so that way they can take timely action. But if you do have a board that plans to take advantage of the less meetings, right, going from 12 to 6, as an institution, you should be thinking about how you are going to keep them appraised of what is going on, whether that's continuing with your monthly board packets and still providing them, whether it's having a more detailed board portal where they can stay up to date on the KPIs and KRIs and escalations that are happening within the credit union, or some other combo or other process that you want to. because you don't want that 1 or 2 management rating to drop to a 3 or 4 because you are technically allowed to take your foot off the gas. And I think that's a good message as we see a lot of deregulation happening across the industry, right? Just because you are not because you are not obliged to do something moving forward doesn't mean that you should stop doing it.
Yes, I have to say, as someone who has served as a board of directors in prior opportunities, less meetings hopefully means better meetings, but that also means better preparation from you and your team. But with that, I just want to say thank you so much for joining us. It is such a busy summer, so make sure you're tuning into your Ncomply. Check out our enforcement tracker where we're letting you know what's hyping up during the summer, new guidance, industry news. And on behalf of Tony, Robert, and myself, we wish you a great rest of your day.